In this session, let's focus more on the financial reporting standards. Those are the kind of rule books, guidelines on how the financial statements have to be prepared. Otherwise, what happens is every company will prepare the financial statement in its own manner, right? They'll use their own estimation. If nothing is regulated, if nothing is streamlined, right? Probably if I have to understand the financial statements of one company, I may have to sit with them for 1 year, right? So, if something is streamlined, saying that all these entries only will have to go as a part of, let's say, account receivable, or these are the entries that go as a part of inventory. These are the transactions that should go as a part of accounts payables. This is how the revenue has to be recognized. This is how the expense has to be recognized. If there are no standards, people can very heavily use their own numbers, and comparisons will become a big pain. And that is where what we see is standards drive the entire world of accounting. And those kind of standards are nothing but your financial reporting standards. So the most commonly used ones, every country used to have its own set of reporting standards, right? Even India has Indian GAAP, which is called as generally accepted accounting principles. So any the auditor also will refer to this rule book and see whether everything is documented as per this book or not. Every transaction, is it documented and final balance sheet is prepared as per these rules only, or is there any kind of a deviation, right? So like that, US has US GAAP. Now, like this, every country has its own kind of gaps, right? Now, because of this, and again, within each country, there are some differences. Probably some rules associated with Indian GAAP could be different from the rules which are associated with the US GAAP. Just let's say one example, if I have to give, let's say the Indian GAAP considers the interest payment which you do on a loan which you take. Let's say it treats it as a financing activity. Just giving a small example. It treats that as a financing activity because you have taken a finance, you have taken a loan. So the payment which you are doing on that loan, which is the interest, you treat that activity also as a financing activity. Whereas the US GAAP says, no, that's an operating activity. Now, because of this, what happens? The entry that goes, that saying single entry, it goes at different places in, as if an Indian company is incurring that, it will go at a different heading. It could be in balance sheet, P&L or cash flow. For time being, let's keep it aside, right? So as per the Indian GAAP, it gets recorded somewhere, whereas as per the US GAAP, it should get recorded somewhere else, right? And if I'm comparing these two, that would be an issue for me, right? Today we are talking of global investments, right? Probably an Indian company acquiring a US firm or vice versa. All these things today are coming up. And so otherwise it becomes mandatory that I have to understand US GAAP also. How many gaps will I understand? If Indian company has to take over Netherlands company, I have to go and understand Netherlands GAAP. Right? To understand at what price I can acquire them, it should not make so complicated that first I have to learn those standards, and after that only I can get into the global transaction. Right? Earlier, the transactions used to take huge amounts of time just for accounting consolidations itself, because the gaps differ. And that is where today we have moved, or we are in the process of moving towards the mechanism of IFRS, International Financial Reporting Standards. So probably all countries globally, they have to follow this standards itself. Whether it is Indian company or US company or any company, they have to move towards following these kind of standards. So that at least simplifies the work of analyst. Or sometimes people also say, if everything is, if every company is following the IFRS kind of standard, probably I can do my practice anywhere in the world. Even as a chartered accountant, I can do the practice anywhere in the world, because across the world the reporting standards are more or less the same. The way a balance sheet has to be prepared, the content of the balance sheet is more or less the same for any kind of a company, right? At the end, these are the items. Okay, probably finance, or sorry, probably the interest payment, it should be treated as this kind of an activity itself. Or probably asset revaluation. Just in the earlier scenario we have just talked about revaluing the asset to the market value. Some country may say no, we will not allow the revaluation. Some other country may say no, we will allow the revaluation. So we don't even know whether the country which we are getting in is allowing it or not allowing it. US GAAP does not allow upside revaluation at all, whereas some gaps allow, even if the asset value has gone up, write it. But US GAAP says even if the asset value has gone up, don't write it. Only if the asset value goes down, write it. But if the asset value has gone up, don't write it. So we have a lot of confusion if at all various gaps are maintained, and that is where the IFRS is trying to address a large number of issues. And if the entire world moves towards IFRS, probably the syllabus for courses like CFA, at least in this financial reporting and analysis kind of section, it may come to half. Right? Typically, in CFA, you deal with the US GAAP as well as IFRS. Whereas once the whole world has moved towards IFRS, today it's almost halfway through. Probably another year or two, it may take typically for the entire scenario being moved towards IFRS. So in that case, even the analysis becomes very easy. Only some small places where there is a deviation, because IFRS is also not fully rigid. It gives some flexibility. You can use method 1, method 2. Depending on where your business is running, for inventory you can still use method 1 or method 2. But again, it is only those 2 methods or 3 methods. Whereas if you go towards each company's gap, each country may have 2 to 3 methods, which will make it much more complicated in the entire process. And even if 2 methods are followed, it will clearly say which method you are following. Please note it down. So even the process is simplified there also. So this chapter primarily talks about what is the role of these standards. What is that? Who sets the standards, and what is the typical role they perform as a part of the financial reporting kind of a space is concerned. So their main aim is to promote comparison between the financial statements. You cannot say that, oh, I don't know anything about the cement industry, so I cannot evaluate the balance sheet of a cement company. Now, the balance sheets are prepared with the same headings, right? So probably you can very well say, okay, revenues, company A, did they go up? By how much percent did they go up? Revenues for company B, by how much percent did they go up? Why did they go up? If you want to know, probably you need an understanding of cement industry and various other things. But they have gone up is something you can easily make out by looking at P&L statement, the balance sheets. So because of the consistency in the presentation, in the way they are presented, they are easily comparable. Whatever the 20 headings you see for a cement company, the same 20 headings you will see for a pharma company. There is no difference in the 20 headings. Cement company lists the same 20 headings in the P&L. Pharma company lists the same 20 headings in the P&L. IT company lists the same 20 headings in the P&L. So comparability becomes more and more easy. Or for that matter, even more to be precise, almost all companies, there is a broad set of 20, 30 points that are said your P&L should contain. So every company typically have to plug in their numbers into that kind of a template itself. So that's the role the standards are playing. And each element, how do you compute it? How do you compute the sales? Revenue recognition method, lot of things come up. We'll deal with each and every element of the P&L statement, each and every element of the balance sheet in the future chapters which we are going to deal with. But for the time being, at least, the main intention of a standard is to bring out the comparability, and whatever the flexibilities you are providing in terms of choices, assumptions, they are a very limited number. Like if you say inventory, I'll still allow 2 or 3 methods, because depending on the business, some companies may have to go with a LIFO method, some companies may have to go with a FIFO method. So depending on the business, let them provide a justification for the method which they are using, but let us give a flexibility to some extent. It's not that no, every company has to follow this kind of a method, but whatever the choices that are available, they are not so broad. They are from a limited set of choices. And if the standards were not there, probably every company will do the reporting in its own form. Some may say accrual basis, some may say no, only when we get the cash we'll treat it as revenue. So every company's numbers will be completely ad hoc. So you cannot really compare the financial performances of the companies. So from that standpoint, it is very much essential that a standard is required. And who sets these